Alphabet Inc., ticker symbol GOOG, otherwise known as Google, is currently trading at $167 a share. This stock has been on a pretty good tear this last year, up 20%. If we compare it to the S&P 500 over the same time, it has consistently beat the market 20% to 18%. What we're going to be doing is looking at my automated stock valuation spreadsheet, looking at the latest company's financials, and then seeing if Google is a buy or a sell using the discounted free cash flow model, the comparable company model, the dividend discount model, and finally the Ben Graham formula for intrinsic value. Now, as I said, Google has beat the market over the last year and has consistently beat the market. If we take it back 5 years, it is up 190% compared to the market's 95. Now what we'll do here is look at my automated stock valuation spreadsheet. Links are in Patreon if you're interested in this, but let me just show you how it works. Firstly, if you type the ticker in the top corner here, what this will do is it will load all the latest company financial data all automatically, and you don't have to do anything. So as we can see here, $167 a share, market cap of $2 billion, PE ratio of 24.39, which if I'm not mistaken is lower than the market average, which is at 29, so that is a good sign that it is undervalued. Earnings per share, $6.87, and a beta of 1.05, which means it is just about as volatile as the market. Shares 5.6 billion, but also we have conflicting numbers here from Google. If we look at my actual data here, this is Google Finance's own data, so you'd think they would know how many shares they have, but they did do a recent stock split. I say recent, it wasn't that recent, but currently they have 12 billion shares. Analysts also saying it's a buy with 200 target price. They do pay a small dividend now, 0.49%, very safe dividend, 4.6 billion, 5.23% payout ratio, and free cash flow payout ratio. Sorry, I was looking at my cat Momo. 7.5%. Now let's have a look at a more detailed view on the revenue. This is the revenue going back to 2015, and you can see it's consistently increased. Had a big jump up post pandemic year, but they have been able to continue growth up to an all-time high of 326 billion. Next, we're looking at the profit, and once again, a very similar story. Profit jumped up massively in 2021, but they still are at their all-time highs in the trailing 12 months of 87, which is good, obviously, because you can see it did go down, air quotes, to a meager 74 billion. Next, we're looking at free cash flow ratio, annual free cash flow, and you can see it's currently at around about 60 billion, which is just shy of its prior of 69 billion. Now we're going to look at the shares outstanding. Obviously, this chart is not going to show it exactly because of the splits. This doesn't handle the splits very well. But if we look at the numbers, and you can see when obviously the split came, you can see that they were buying back shares, which means two things. One, Google may think that they are undervalued, so they want to buy back their shares. But then also they are rewarding shareholders, because if you own one share and there's 10 shares, then you own 10%. If they buy back 5 shares, you own then 20%. So that is good that they're rewarding shareholders. Assets versus liabilities, high assets and liabilities. Now you can see the gap is closing, but overall this looks pretty good. Now let's have a look at the discounted free cash flow model. What this is a way of valuing stocks, looking at the future free cash flows, discounting them to today's value. And let's see what this says. Now, I don't think this would love it. In fact, actually, what we'll do also is we'll look at the trailing 12 months, because we do have more recent data. And this actually puts the stock at about, sorry, let me go here. We will look at this one. We'll look at this one first, because I've actually got the wrong stock price number in there. But we can see, actually, it shows that it's working. Currently average at $104 a share. So let's look at these numbers and see if we're close. So this is a revenue growth rate of 10%. Let's see what analysts are saying in terms of Google's expected revenues in the next few years. In 2024, 2025, high side 400 billion, which is actually we're about that one. So let's just up this just a smidge. That puts it at a $106 stock. And then also net income margins, I'm going to assume these are going to increase. And free cash flow ratio, let's take an average of these last three numbers here, which puts us at around 77%. 7%. And that puts a calculated stock price at 130, which obviously is lower than the 167 price. But in terms of a discounted free cash flow model, being close to liking the price of a sort of growth tech company or a growing tech company like this is still pretty rare and good to see. The main one I want to look at here is the comparable company model. Now, what this is a way of valuing companies looking at metrics of other businesses of a similar size and industry. The ones that jump out to me immediately, obviously Microsoft, Apple, and we'll go with Amazon as well. Now what this will do is it will load all the company's financial data of the companies you've just added to then for your comparison. As again, if you're interested, check out the Patreon. Enough of the hard sell. Enterprise value, these are all similar-ish companies. Obviously, Apple is the highest with Microsoft, and then Amazon and Google pretty neck and neck. Revenue-wise, Amazon has a higher revenue because of their e-commerce side, but you can see that 300 billion higher than Microsoft's and just shy of Apple's again. Growth rate here, this is quite interesting. Google with the second highest of 17.43%. EBITDA, earnings before interest, taxes, depreciation, and amortization, once again quite similar, 115 billion, 129, 131, and 104. Google is the second most profitable, just beating out Microsoft and behind Apple of 102 billion with 87. Profit margins, very similar to Apple, only Microsoft is beating them with a 36%. Now, these is why I thought this would be very interesting. If we look at the price to sales and price to book, which are the company stock price compared to its revenues, and then the company stock price based on the ratio of its assets minus liabilities compared to that, and it is the lowest apart from Amazon in terms of price to sales. So that is very, very good to see. Another interesting one here is the PEG, which is Peter Lynch's value, or one of his methods of valuing stocks. I suppose this is just a quick ratio of the earnings per share growth price compared to earnings growth ratio. One fairly valued, higher is overvalued, less than is undervalued. Obviously these are all under 1, but Google or Alphabet is the lowest with 1.2. Now let's have a look at these metrics here. These are the EV to revenue, EV to EBITDA, and PE. Lowest PE, lowest EV to EBITDA, and second lowest EV to revenue. We might actually look at Amazon without this, but based on these three companies as their comparison, it is undervalued with an average price of $210 a share. Now, if we were to take out Amazon and look at this sheet here, it actually puts it at a price at around about $220 a share. So big growth expected based on the comparable company model. Dividend discount model, actually we can't use this because Google does pay a dividend, but in a few years we can start using this and seeing what it gives a value based on that. And the Ben Graham formula for intrinsic value, created by the father of value investing himself. Let's have a look what Google's expected growth rate is over the next few years, and they're actually expecting a 20% growth rate. So let's put in 20% here. Ben Graham says it's a buy actually, and that is quite interesting. Even with these high bond yields at the minute, AAA bond yields, you can see here if I go to the Moody's seasoned AA corporate bond yield, 5.12%. This is pretty high. So if this was a less inflationary environment, let me just have a look at what some prior numbers were. Back in, well, we won't go that low because they were quite low. So if, let's say that the average is around about somewhere 3.5%. If that was at 3.5%, it would be a definite buy. So quite surprising that once again, a tech giant such as this, Ben Graham's formula for intrinsic value says it is a buy. One thing I just wanted to quickly look at, if we were to compare Google to those competitors that I said, Apple, we'll also add Microsoft, and we will also add, oh, bugger, oops, shouldn't swear, Google, Apple, and finally Amazon. If we compare how these have done over the last year to date, I won't go through all the numbers here, but all pretty close. Year to date, Apple and Google seem to be the leaders here. 1 year, pretty neck and neck again, and 5 years, Apple is in the lead with Google and Microsoft pretty close. So quite interesting to see there based on those valuations. But from comparable company, it looks like Google is undervalued to its competitors, so this could be the time to buy. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.